Alright guys, so we just finished up chapter 8, we're headed to chapter 9. So for chapter 9, first thing we're going to do is we're going to go to our company name, change it to case 1, like always. Case 1, student's name, and save. Alright, so once we have the name updated, we are going to dig in. Number 1 says, open and review your previously customized report named trial balance as of 1/31/18. So we're going to go to reports, custom reports. They want the transaction or trial balance for case 1. And it says, number 2A, an inventory of supplies reveals that only $75 of supplies remain as of 1/31/18. So if I go to supplies asset and it says $375, but I only have 75, that means I need to decrease this number by $300. So to decrease this by $300, I need to do an adjusting entry. So create my journal entry, and it's going to bring me up my journal entry. Now if you guys get stuck on these, go back to the chapter notes in the beginning of the chapter, and we're going to do figure 9-2 walks us through what we're going to do, right, to record an adjusting entry for supplies in the sample company. So it's page 158 if you have any questions. The first thing we need to do is we need to change the date here. The date here is going to be 1/31/18. 1/31/18. Yep. All right. So the first account that we're going to have to do anything with is going to be the supplies account. Now think about it. And it's not necessarily the supplies account. We're going to have to deal with the supplies account, and we're going to have to deal with the supplies expense. So figure 9-2 walks you through how to do it if you need to increase the supply. Now, to increase the asset, you're going to debit the asset and credit the credit. You're going to debit the asset and you're going to credit the liability. But for the opposite, you're going to credit the liability and credit and debit the expense. So if you look on page 160, it's going to show us that supplies, and this is supplies expense, is going to be debited, and supplies asset is going to be the credit. So we're going to look and see if we do not have a supplies expense. It would say over here that it is an expense on the right hand side. And if it's not, we might need to create it. Supplies right there. So this is a supplies expense, and it's $300. That's what we need to reduce this by. The second one is, what are we reducing, right? I mean, like, what is the account that we need to credit? And that is supplies asset for case 1. So right now we have a debit balance of $375 in supplies asset. If we add a credit to it for $300, then we only have a debit balance of $75, which would mean we have $75 left. So that's how you're going to do it. You're going to debit supplies expense, because supplies expense increases with a debit. Expenses always increase with the debit. And then the assets will decrease with a credit. There we go. So we're going to click Save and New. That's your first transaction. 2B says $800 of prepaid expenses expired, representing a prepaid rent in the month of January. So if our prepaid expense is reduced, how do we handle that? So if prepaid expense is being reduced, think about it. Prepaid expense, which is an asset, is going to be reduced. What are we going to do? We're going to decrease it, right? So that would be the same as saying that our rent expense increased. So the first one here is going to be our rent expense. Now we need to see if rent expense is even on here. Commissions, insurance, payroll, rent, or lease expense. Yep. And that's 800. And right now, prepaid expense is an asset, and we're going to decrease it. So we're going to credit it. Prepaid expense. Gotta get down to them. Prepaid expense is an other current asset. Here's prepaid expense right here. And it looks like there's only one prepaid expense. So prepaid expense is going to decrease by 800 and rent or lease expense is going to increase. We got the right date in there. We can just hit save and new. All right, so that's B. C says a bill for $150 was received and recorded in the month for repairs and maintenance consumed in the current month. Create a new liability account as you did earlier in the chapter. A bill for $150 was received and recorded in the month for repairs and maintenance consumed in the current month. Oh, in the next month for current month. So what we're going to do here is going to look exactly like page 163, right? A bill. It doesn't say what we're buying. It just says repairs and maintenance. This is case 1, so we're going to assume that it was, oh gosh, we don't know if we can assume that it's a service or a sale of a product. We're just going to take it out of sales. So we're going to do, and it doesn't give us a account name. Nope, doesn't give us an account name either. It just says that it's going to be unearned revenues. All right, so we're going to do sales is obviously a equity account, so it's going to increase with a credit. So we're going to decrease this with a debit. So that's where we're going to debit sales. So it's going to be a, I'll find it here. Right here, sales. Sales is what we use for case 1. And it's going to be for a bill for $150 was received and recorded for the next month. Well, so this isn't necessarily saying sales. It's just saying that a bill. I'm not going to change that. I'm not going to do sales. I'm going to use a, technically I should create a maintenance or a miscellaneous account for that. It would be nice if it just told us what the account name was, so that we all did the same one. Repairs and maintenance consumed. Because they use design income. We're going to consider this as an expense because it says that a bill for $150 was received and recorded. I mean, a bill is something that we're going to assume this is an expense for maintenance that we consumed. In that case, we're going to do exactly like it says on page 161 for accrued expense. And in the case that we have an accrued expense, we're going to have like maintenance is going to be our debit. So we're going to find maintenance, maintenance, maintenance. Repairs and maintenance. This is where our debit, and it's 150. And so that we keep this in the current month. And then we're going to do accrued liabilities here. I don't think I have an accrued liability, so we have to create it. I'm going to check and find out. No, I do not have accrued liability. So add new. It's going to be a other current liability, and it's going to be other current liability, and then we're just going to call it accrued. ACC or UED liabilities. Save and close for $150. So again, this is C, where it says a bill for $150 received and recorded in the next month for repairs and maintenance consumed in the current month. We're going to assume that those are repairs to our building. So this is a bill coming to us, not a bill that we sent out and someone paid. So if we have a repairs and maintenance expense that hit in the next month, but it should hit this month, we would go ahead and take it out of this month, meaning we want to go ahead and issue it as a debit to increase our expense for this month, and then we're going to issue a liabilities for accrued liabilities. So this means next month we have to pay it, but it should be paid this month. That's what it does in effect. So we're going to save a new. That was a little tricky one. They don't give you much to go on. D says consulting services recorded on sales receipt 1004 for $2,500 to Surfrider Foundation were never performed, even though the cash had been received. So this is unearned revenue. Thus, the revenue had not been earned. Create a new liability account as you did early in the chapter. So this tells us that it's unearned revenue, straight up. So this is good. We're going to follow the bottom of page 162, where it talks about how we do unearned revenue. So here they created an account that says design income, or use design income, but we don't need to do that. We know that this is going to be sales receipt to Surfrider were never performed, even though cash had been received. Consulting services. So this is services. This is not sales. Something to keep in mind. So accounts, we're going to go down to our, they're going to be equity accounts. I passed them up. Income accounts, consignment, sales. So sales of product income, this would be chapter 3. This is chapter 1 and 2. Service is chapter 1 and 2. So we're going to do services because it says service. And that amount was $2,500. Oh. Debit, $2,500. My credit is going to be to unearned revenue for $2,500. Unearned revenue. Not undeposited funds, unearned revenue. And we'll need to see if it's even created. It might not be. I do not see it. Yep, it's not created. So I'm going to add new. And I'm going to select income account. And the primary sales of product income, service fees. That's not it at all. Unearned revenue is a liability. That's why I can't find it under there. So other current liabilities. Other current liabilities. We should see unearned income. It could be under other current liabilities, other current liabilities. And then we're going to change the name to unearned income. Unearned income is pretty common for businesses that do any type of billing. So if you do have a service business, you definitely have unearned income. Even if you do sell products from time to time, you might have unearned income. So it's a really common account to have, and I'm surprised that it's not built into the system that already have one there. But so it's a other current liability because we owe them this until we perform the service that we got paid for. So it's a liability in our books right now. So we're going to save and close that, and it's for the same amount, $2,500. So at the end of the month, we're going to increase our services by $2,500, right? And we have unearned income of $2,500. So we're going to increase our services, or we're going to debit services by $2,500 because we're technically decreasing it, because it was previously increased. Service would increase with a credit because it's that equity account. Unearned income is a liability account, so it's going to increase with a credit. So in essence, we are decreasing our income of services and we're increasing our liabilities. So we're going to save anew. Number E says consulting services of $8,500 were performed on the last day of the month for a new customer. Blaze boards, but not invoiced to the customer or recorded into the accounting records until a few days into the next month. Create a new asset account as you did earlier in the chapter. So the asset account is going to be for, I guarantee you, accrued revenue. Accrued revenue can be found on page 164. To record an adjusting journal entry to reflect earned revenue, do the following. So we earned this revenue, but we have not recorded it yet. So we're on this date for the 31st, and we are going to first do accrued receivables. And they owe it to us, so we're going to have to, it's a receivable, it's not necessarily a sale. So we have accounts receivable, but that's not what it is. It's an accrued receivable, because we're going to accrue it this month, but it takes place next month. So I'm going to have to create this account. To add this new account, it is going to be a asset, probably an other current asset. Other current asset. Other asset. Other current asset. There we go. And then if it doesn't have it here, and it doesn't, it's going to be another current asset. Then we're going to name it. And we're going to call it accrued receivables. Accrued receivables. There we go. Save and close. And this is the amount of $8,500. Now that we know that this is accrued receivables, but we also know that it is for a person. So down here for the name, we're going to add Blaze Contracting to it. That's what it is, right? Blaze Contracting. Blaze boards. Blazing boards. Good Lord. So BLAZING-BOARDS. Blazing boards. We're going to add blazing boards. Now, are they a customer or are they a vendor? Think about it. Blazing boards. They're a customer because we did work for them and they paid us, but we are accruing the receivables because we didn't receive it until the next month. They're not a vendor because if they're a vendor, we'd be paying them. They're a customer. So we're going to save. And then the next one is going to be our area that we sent it to. Is it consulting or is it? Yep, consulting. So we know that we need to do service. Right, for $8,500. And then we're just going to put this blaze here too. Blazing boards. So we know where that's at. So we're on accrued revenues and we're going to credit service. We're going to save anew. And the last one says depreciation expense of $575, $75, and $500 for equipment and furniture and fixtures respectively. Needed to be recorded for the month. Before recording this journal entry, edit depreciation expense account so that the new name is depreciation expense. Also change the account titled furniture and fixtures accumulated depreciation from depreciation to accumulated depreciation, as you did earlier in the chapter. This is going to be the same as we do on page 165. To edit an account names, do the following adjustment entry. So to do this, we are going to have to, and this says 11/31/16 for the journal entry. Oh, that's just the test drive. So this is going to be depreciation expense for case 1, furniture and fixtures. Well, actually, it's equipment and furniture and fixtures. So let's do equipment first. Building, furniture, fixtures, machinery and equipment. Machinery equipment case 1. So the first thing we're going to do is depreciation expense. So I'll click on this. And I want to call this depreciation expense. So I'm going to click into the box and I'm going to change it. Now, me being me, I'm going to leave case 1 there just so I know. Case 1, depreciation. And I don't want to add this, I want to edit this. Why won't it just let me edit it? It wants me to change it. I don't want to add that account. I want to edit this account. Equipment case 1. Man, let me edit it. Let me edit it. No. Let me edit it. Now see, it doesn't work like the book says. Click edit from the drop down arrow next to the words view register. We're going to go to the chart of accounts for this. I didn't want to do that. Leave without saving, yes. Chart of accounts. We're going to go down to machinery and equipment case 1. Depreciation. Drop down, edit this bad boy. Depreciation name is depreciation. Depreciation expense. Save and close. And your accumulated depreciation. Boom, boom, boom. Pause this. Alright, so what I want to do is I want to go back to that. I typed this into accumulated expense, and it's not going to be depreciation expense. This is going to be accumulated depreciation. Accumulated depreciation. This is how it's going to grow. So I'm going to save and close that. Now what I want to do is I need to have a depreciation expense account that I just keep adding to, and it's just one account for everything. That's going to be clear down here where it says depreciation right above miscellaneous. It's an other expense, and I'm going to edit this, and I'm going to call this depreciation expense. Took me 2 seconds to decide which one I was doing, but there we go. So now every time that we want to depreciate one of these assets, we're going to change this depreciation right here to accumulated depreciation, because it'll increase as for the asset until it hits the original cost amount, and then we can't depreciate it anymore. And we'll use for depreciating expense this extra account down here, right? Because this is another expense. So now it makes sense to us, or at least I hope it does. We're back to our journal entry, and we are on the 31st. Depreciation expense is the first one we're going to do. I'm going to start typing it in here. Depreciation expense under other expenses. It's not a sub account. So other expenses, depreciation expense, and this is for $575. I can do them all at once. $575. Now I'll show you how that works. $575. The first one is going to be for the equipment for $75. So I'm going to go to this equipment that I just changed. Machinery and equipment case 1, accumulated depreciation for, nope, just $75. The second one's $500 for furniture and fixtures, respectively. So I'm going to go to furniture and fixtures for case 1. That's this one that doesn't have any case 1 beside of it. Furniture and fixtures, this depreciation, and it's going to be $500. Now technically I should change this to accumulated depreciation 2. I didn't whenever I was already in the chart of accounts, but I need to when I'm done here. So on case 1, 2F, this is how you're going to set it up. You're going to change your depreciation on your chart of accounts, clear at the bottom, to depreciation expense. And then you're going to change your furniture and fixtures depreciation and your machinery and equipment depreciation for case 1 to accumulated depreciation for their name. And when you come into your journal, depreciation expense is your debit, and your 2 credits are your machinery and equipment and your furniture and fixtures, respectively, for the $75 and the $500. Once you're here, you can save. And I'm going to exit out of that. I'm going to go back into my chart of accounts. I'm going to go to my furniture and fixtures for case 1. And I'm going to go down to depreciation. I'm going to view or edit. I'm going to call this accumulated depreciation. Just so that I'm consistent with what the book tells us to do. Alright, so now that should be good to go. So now we're on number 3. It says print and export to Excel your previously customized reports, and so this is just where we do our reporting. So to do our reporting, we're going back to reports. We're going to customize reports, trial balance for case 1. We're going to export this bad boy, save as PDF, saved it. Going to go back to your report list. Transaction detail by account case 1. We're going to export PDF. Save as PDF. Gosh, I'm losing my voice. And here we go. This is what the trial balance by detail look like. Page 1, page 2, and page 3, and page 4. If you didn't get a good look, make sure you pause the video. To go back to the trial balance, this is what it should look like. 144, 494, 99. If you guys have any questions on this, don't hesitate to reach out to me. But other than that, that's case 1 for chapter 9.